Hello and welcome back to the MCF Participant Education Series. My name is Hunter Nighbert, and I'm a financial advisor and retirement planning specialist with MCF Advisors, and we are your company's retirement plan consultant. It's the third quarter, and our education topic is market volatility, and today we're going to be discussing behavioral finance. What is behavioral finance? Well, behavioral finance is the intersection of behavioral psychology and finance that helps us explain why people make the financial decisions that they do. And there are underlying traits and behaviors that really inform every financial decision that we make. Why is this important? Well, along with the practical challenges, investors should remember the significant role that emotions play in investing. Market volatility definitely can affect investors' emotions, and which there in turn can affect their decision making. To illustrate that is a study that shows returns from 1992 through 2021 that shows average investor returns versus their respective benchmarks on stocks, bonds, and a diversified portfolio. And as you can see on there, average investors significantly trailed those of the benchmarks in every single case. And that's because average investors in general eventually will have an event or an uncomfortability and anxiety driven by emotions that will make them possibly make a poor decision or an irrational decision at the wrong time, which costs them significant in long-term returns. The human brain is hardwired to make a lot of these decisions, and by discussing some of these behaviors and really becoming more aware of them, the goal is really to help you avoid emotion-driven decision-making and help you expand your perspective for coping with the anxiety of dealing with these emotions. Technology also plays a major role in our lives, especially in today's age, because of the sheer amount of knowledge that we all have at our fingertips. But the advancement in evolution over the last, 3 decades or more really has helped shape how humans interact with one another and as well as make decisions. And that starts with the computer revolution that started in the 80s. Along with the convergence of the internet, the upgrade in speeds of internet, nanotechnology, and the creation of the smartphone, which led to platforms for algorithmic computer-based trading models, as well as today being in the early stages and on the precipice of the artificial intelligence revolution, which will add another layer to this because artificial intelligence will be used in many ways, and but the filtration of that is still yet to be, even unrolled for that much. Really, everyone's background and personal experience really plays the largest role in our financial decision-making process, and really just core beliefs in some ways, which are rooted in personal experience, by the way. However, our family, our parents, our upbringing, our immediate environment, community, societal legends and beliefs often contribute in a heavy way to how we view things from a financial standpoint. However, it's really our life experiences, good and bad, that really shape the most difficult habits or beliefs that really impact our decision makings. And those are the toughest ones in some cases to avoid. So there's 6 types of behaviors that we're going to discuss. We're not going to go in detail of all of them. I'm going to skip through a couple of them, but really give you a couple of examples of how they relate in some ways to investing. And that's anchoring bias first, confirmation bias, recency bias, herding bias, ambiguity aversion, and myopic loss aversion as well. So anchoring bias is a common decision-making habit, especially when it comes to shopping, buying things, but it can too when it comes to investing. It's focused on relying heavily on what someone sees first, which then anchors their decision. And the example above, the product that everyone is dying to buy was in fact anchored by showing the shoe was $500. And now it's a great deal because it's on sale for $199 versus the example on the left with no anchor generally does not elicit that without an anchor first. Same thing when it comes to purchasing stocks in terms of dips. And, sometimes when the market goes down, we're hesitant to put in over the anxiety of that. There's nothing to anchor us if we just looked at what it was in weeks before, perhaps, maybe that would be an anchor way to overcome the anchor on that. Confirmation bias, which ultimately is just someone having their mind made up of what decision will be before the options are even laid out. And many people will filter out the answers they don't want to hear in order to confirm their original decision. Really prevalent throughout life, honestly. Recency bias, this is a big one. Having a quick reaction based on recent experience instead of thinking through past experience or maybe changing your perspective or looking at history. The recency of events and outcomes trigger people to make decisions without fully thinking things through. A real example on this one lately has been inflation. Inflation has impacted so many people over the last several years. And so the automatic response is that inflation will continue at the rate that it has been, because that's what it, most recently really affected everybody. When in reality, there were times prior to the pandemic, for example, really just before the pandemic, where we had years of negative inflation. So that can occur. But really, what happens recently really shapes it up, especially in terms of volatility and big dips in the market. And I love this quote by Warren Buffett. What we learn from history is that people don't learn from history. When investors get either too fearful or too greedy, they sometimes hide behind the notion that somehow this time is different, and they usually regret it. And I see that quite a bit. Ambiguity aversion is a paradox that shown on the slide that helps illustrates people's decisions are not only affected by probability, but also by the degree of uncertainty or ambiguity. So in this example on the left, if a person had to choose between option one, which is 50 red balls and 50 black balls, their probability of success is 50-50, one of each. But if you made them pick from 100 red balls and black balls that are mixed without knowing the ratio in there, well, the unknown will clearly drive them away from something that they feel has a more certainty to it, a probability. But that's not always the case as well. Myopic loss aversion, lastly, we'll look at this. It implies that a loss, in this case $100, is twice as painful as the pleasure received from an equal gain. I find this to be true as well, especially during periods of time of market volatility. Studies have showed that when people were faced with the choice of making a bet, more choose to walk away than accept the bet. It's only when the potential gain was 2 times higher than the loss that people look to make that bet under that study. So it's very important to understand that if I understand when you look at your account and your account is down, to not react to the uncomfortability in the short term, which is what many people do. They look at their accounts and they feel like, hey, we have got to do something. It's that fight or flight, because I can't sit here and watch this, that we have to do something. When in fact, doing something often leads to a worse outcome than just letting it work itself out because it's more of a short-term anomaly versus something in the long term. Here to illustrate that very point, since 1950 to 2022, this is the spreads from low to high for stocks in a 1-year period, 5-year, 10-year, and 20. So in any given 1 year period, the stocks were down as much as 39% in 1 year and up 47%. But look what happens when you go out in 5 years. The spread compresses greatly. 10 years, the loss compresses even more than it did in the 5 years. And then go to 20 years, and then it even gets better on a 30-year. The spread, there is no negative on a 20-year rolling average since 1950. So what happens is these big dips inform us and that we feel like we have to make a decision, when in reality, we should sit tight, continue in the investing process and participating in the markets versus trying to succumb to our anxiety. Another example of how you can't time this thing, I've always said it's time in, it's not timing. So this is the S&P 500 from 2003 to the end of, so a 20-year period. You invested $10,000 in January 2003 and left it in there the entire time. You would have made a 9.8% year-over-year return and would have almost $65,000. But if you had missed the 10 best days of trading, the best days, 10 best days out of that entire time frame, your return would have been cut in half. If you missed the 40 best days, you would have lost money. And that's 40 out of 40 days, trading days out of a 20-year period. And here's the kicker. 7 of the 10 best days occurred within 2 weeks of the 10 worst. And 6 of the 7 best days occurred after the worst day. So what that tells me is that, I've always known that if you're going to try to time the market, you got to be right twice. You got to know when to get out, when to get back in, and no one's right twice. Professionals can't do that. So you're way better off to participate. Yes, you might have fluctuations in the short term, but in the long term, those fluctuations lead to returns. This is a really good example of doing that and not trying to time it by getting all you can get. So lastly is avoid information overload. The amount of information at our fingertips is rising exponentially. The average American spends 5 hours and 24 minutes on our mobile device per day. And Americans check their phones on average 96 times per day. So 5.5 hours and 96 different opportunities you have in order to gather information. Some of that information is noise and loud, and some of that doesn't have anything to do with it. But you've got to be careful of that information overload. It can really have an effect. It can really create that recency bias. On that same subject line of checking our phone too much, frequent portfolio evaluation can lead to more risk-adverse behavior. Because looking at it more, you see those ups and downs all the time, and you get entrenched in that I have to do something. So be careful of doing that. I'm in this business. I don't look at my I look at my retirement account maybe once a quarter, maybe. And I see stuff every day. So don't get trapped by focusing all your energy on what happens from one day to the next. So now let's look at how to address these behaviors. For anchoring bias, just acknowledge the anchor when you're making decisions and recognize that the ways choices are presented often affect your decision. Confirmation bias, admit, there's different situations call for different expertise and seeking out other options and really alternative ways of thinking are healthy versus kind of that group think. Recency bias, yesterday's truth is not tomorrow's. And no pattern, even if we're in a period of decline, no pattern continues forever, especially in investing. Herding bias, not going to jump on that too much, but running with the crowd, it might prevent, solitary embarrassment, but it won't keep you from being wrong. The old Pied Piper and Lemmings, we know that story. Ambiguity bias, goal-based planning, folks, is the key to your success. Outcomes should drive your actions, not the fear of the unknown. And then lastly, myopic loss aversion coping. Financial losses are often locked in by panic selling. So when you sell when you're down, and it takes twice as long for you to get back in before you're comfortable. And when the market already repairs itself or is on its way to repairing itself, you might have locked in some losses. That goes back to the first slide that we saw of the average investor trailing those benchmarks. And keep a focus and a long-term goals in order to drive your success. Lastly, help break the behaviors of yourself. Know yourself a little bit better. Become more aware of how your tendencies influence your own financial decisions. Avoid panic selling. Guys, if you are stressed and have anxiety about the markets, schedule a meeting with me. Let's talk about it. I'll bring some perspective to it. Stay invested during the times of volatility and uncertainty. Don't dwell on the past and focus on your long-term goals and your time horizon. And then always consult the financial advisor for broader perspective, which brings us to our last. I welcome the opportunity to hear from any of you. So reach out and ask. I'm here as a resource for your retirement success. So scan this QR code to schedule your one-on-one appointment and avoid the many mistakes that investors make and remain disciplined in order to reach your goals. That's all I have for today. If you found the information on this video useful, I would encourage you to share it with your friends, family, and colleagues that you work with. And that's all I have for today. We'll see you again sometime in Q4 with our financial planning topic. But that's all we have for today. And I hope you all have a good one. I'll talk to you soon.